Hey everybody, Sean Lowry here with Timber Run Capital. I wanted to go through some of the more common return metrics that you're going to hear as a prospective passive investor when you're looking at different opportunities. Some of the most common terms that you're going to see in offering, just to give you a better understanding of what each one means, help you determine what is most important for you, the criteria that you set for the deals that you're looking for, what makes a good deal, what makes one better than the other. Well, let's dive in and hopefully this helps you get a little clarity around what that means for you personally. So cash on cash return. In simple terms, we're using an example here of an investment of $50,000. This is a 5-year projected hold of a property. And we're looking at the cash flow that you as the investor receive based on your $50,000 investment. So year one, let's assume you get $2,000 in cash flow distributed to you. You invested $50,000. It's a 4% return. $2,000 divided by your initial capital investment of $50,000 is 4%. Year two, 3,000, 6%. Year 3 through 5, $4,000 each year. So your total cash flow over those 5 years was $17,000. So when you hear average cash on cash return, that takes your total cash flow received or distributed to you, divided by your initial investment, divided by the number of years of that investment that it was outstanding. So in this case, 5 years equals an average cash on cash return of 6.8%. Now, keep in mind, the cash on cash return typically does not include the proceeds from sale. That'll be in what's called internal rate of return, or IRR, an average annual return, which we'll look at in a moment. So that's your cash on cash return. What is your investment generating in return any given year from the operating cash flow? Another common term you'll hear is what's known as the cap rate or capitalization rate. And that is simply a formula that calculates the net operating income divided by the sales price. Cap rate in an all cash purchase would equal your cash on cash return. That'd be one and the same. But typically, most assets are purchased using some sort of financing. So this does not factor in financing, while cash on cash return does. So the cap rate effectively gauges the market's risk adjusted expectation of return. So it depends on location. So if there's a more desirable location, you might have a lower cap rate or lower expectation of return compared to a less desirable location, where you might, as an investor, expect a higher rate of return to account for the higher perceived risk. The vintage or the age of the building. An older building might demand a higher cap rate or higher expectation of return than a brand new building. The condition, clearly, if the property needs a lot of work, or is an area that in general, most properties need a lot of work, which goes back to the location, that might impact the cap rate or expectation of market return. And then unit count. A larger asset might have a lower expectation return than a smaller asset, but that could vary. So cap rate and value, just to keep in mind, have an inverse relationship. Think of a seesaw. As the cap rate goes down, your value goes up. So the cap rate or the expectation of return, as if that is lower, then a prospective buyer is willing to pay more for that asset to generate that lower return. On the flip side, if the expectation of return or the cap rate is higher, price that a buyer could pay to generate that higher return would have to be lower. So an inverse relationship. So the importance in my mind of knowing what the market-based cap rates are is that I want to make sure I'm not wildly overpaying for an asset compared to what similar assets sold for in that area. And then furthermore, if a value add strategy is part of your repertoire, so in other words, where you're going to go in and improve that stream of income, that net operating income, which therefore drives a higher value, it's important for me to know, well, what is my going in cap rate today, day one, compared to where I can take it? If I can boost the NOI, I can effectively develop or add enough value to that property to boost the cap rate. And then when I go to sell it, I'm going to be selling it at the lower market cap rate with higher income and therefore generate a higher sales price. But it is still important to recognize from a comparable standpoint what other similar buildings are selling for, what their cap rate is. Preferred return. It is a relatively common metric that limited partners or passive investors might see in an offering that they're considering. So a pref is what preferred return is for short. And basically it's what portion of cash flow distributed goes first to the limited partners for the general partners see a dime effectively. So for example, let's say you're into a deal with a 6 pref, you make a $50,000 investment. Each year, you are entitled to $3,000 or your initial investment of $50,000 times that 6% preferred return, the first $3,000 that gets distributed has to go to you and the other limited partners, of course, if any, before the general partner sees anything, what's known as a promote, above and beyond that preferred return. What happens in the event that your pref is not met? So let's say you're buying a building that needs a lot of work, and maybe you're not going to have high cash flow year one, maybe year two. So, but you're still expecting that $3,000. Well, let's say you only receive $1,000. Well, you need to ask the general partner, the sponsor of the deal, what happens? Is that $2,000 accrued and then carry over to next year? Let's say there's more cash flow next year. You make me whole on year one and then pay me my pref on year two before you see anything. Is there interest charged on that accrued shortfall of pref return? That's known as compounding pref. Cumulative pref would be if you fall short, that carries forward. And sometimes you might have a pref on paper that doesn't get paid to you until the deal sells or has a cash out refinance. So just important to understand the flow of things, especially if you fall short, ask the sponsor, well, what happens? It's important to know that. Another common return metric that I see is what's known as average annual return, or AAR. This is a pretty simplistic approach to return. I think it's important to recognize this. It takes the invested cash of $50,000. You look at your cash flow stream here that we had in the previous example. And so your total cash flow over 5 years received is $17,000. Then we factor in the proceeds from sale. So we assume a year 5 sale, we're getting $20,000 from that. So the AAR is your total cash flow plus your sale proceeds, lump those together, 37 grand, divided by your initial cash investment of 50, divided by 5 years. We're taking the average return. So we're taking our total proceeds that came to us, divided by our initial investment. So take that total return, and it was over a 5-year hold. So we divide that by 5, and we get on average each year, we average 14.8% AAR. So we'll see, because we factored in sale proceeds, of course, it's going to be higher than cash on cash return, which just accounts for your operating cash flow distributions. Now, AAR is different than internal rate of return, or IRR, which we'll touch in a moment. Internal rate of return, or IRR, is a great way to account for what's known as the time value of money. So it's fairly similar to the average annual return. It accounts for all your cash flow from operating cash flow, your distributions that you receive each year. So in this case, we have $17,000 in cash. And let's look at this left side. I'm going to give you 2 examples here, but we'll start with this one over here. So we put 50 in. We received 2,000 year 1, 3,000 year 2, 4,000 year 3, 4, and 5, 17,000 total over 5-year hold. Plus, we're going to account for the sale proceeds of $20,000. Plus, we're going to receive our initial capital back of $50,000. Our IRR, which accounts for when these funds were received effectively, will be 12.8%. Now, let's compare that to the average annual return, which we looked at before, was 14.8%. So what's the difference? Well, the average annual return simply says, well, the total return divided by the number of years that you held that investment is your average annual return. It does not account for when those funds were received, when the IRR does. So the IRR is more sensitive to how long of a hold period there is and when the funds were received, the distributions or proceeds from sale were received back to you. So for example, the exact same total cash flow in this second example over here, based on a $50,000 initial investment, sale proceeds still $20,000. You're getting your $50,000 capital return to you, your investment back, and yet the IRR is higher, although it's the same amount of overall return. The reason is we're getting more upfront. So we're receiving $5,000 on our investment year 1, 2, and 3 compared to $2,000, $3,000, $4,000. So because the time value of money says, well, there's more back in your pocket today that you in theory can reinvest. There's less opportunity cost to have that capital locked in the deal. And as a result, your IRR is slightly higher. So what's better, AAR, IRR? Well, it really depends on your objectives in your investing, but it's important to know the distinction between the two, as some operators, some sponsors will lean heavily on average annual return, AAR, because it typically shows a slightly higher rate of return compared to IRR. Equity multiple, another simplistic but very important way and a great way to compare from deal to deal, just like IRR. You have your initial invested cash of $50,000, $2,000 year 1 coming back to you, $3,000 year 2, $4,000 for the next 3 years. We then sell the asset. You get $20,000 based on your investment. So your total return, total distributions of $37,000. You get your initial capital back of $50,000. So your total return cash, so your initial investment, what you got back, plus all the returns that came in over the 5-year hold, are $87,000. So to calculate equity multiple, we take the $87,000 in return cash, divided by your initial investment of $50,000, and that leads to a 1.74x multiple, meaning that your total return, you receive back 1.74 times more than what you put in. Is that good? I think so. It just depends on your objective, your criteria. That's why I'm just showing you how we calculate this, and you can kind of back into what your search criteria is so that you know when to define a good deal versus a mediocre one. So let's recap real quick. We use this example of a $50,000 initial investment, $17,000 in cash flow distributions over 5 years, and a proceeds from sale of $20,000. So cash on cash was 6.8%. AAR, average annual return, 14.8, which was higher than our IRR of 12.8, because the IRR accounts for when those funds were received, time value of money. The sooner you receive the money back, the higher the IRR. The AAR is just a simplistic approach, taking the average return any given year, or taking the average return based on your hold period. And then your equity multiple, 1.74x. So good deal, set your own criteria. I hope this will help you define for yourself, well, what makes a deal worth pursuing versus saying no? Saying no is okay, but what are you saying no to? Put the work up front in deciding for yourself what makes a good deal, so that when you review a deal offering from a sponsor like myself, you know pretty quickly whether to weed it out or to dig into it and explore it further. I hope this was helpful for you. Any questions, please visit my website at gotimberrun.com. And if you're interested in passive investing, please visit the website and you can inquire there, and we'll look forward to connecting with you soon.